Welcome to Spring Law's SpringForward Legal Updates webinar series. This series is designed to provide a comprehensive legal overview of key issues related to employment law and human rights in Ontario. Spring Law is a virtual employment law firm advising on workplace legal issues for employers, employees, freelancers, and executives from a wide range of industries. We hope you enjoyed today's webinar and find it useful and informative. To reach our team, please visit us at springlaw.ca. And now to our presenters.
Good morning, everyone. Welcome to episode 67 of the Spring Law webinars. Super excited about today's presentation. For anyone that hasn't joined us before, Spring Law is a virtual firm that does everything employment law, and today's presentation is focused on tax and employment implications of mergers and acquisitions. Quite a niche topic, but a topic that we go through quite often and an important topic. And I don't know how long it's been, Jeremie, but I feel like I contacted you about this a year ago. I did that thing where I want to do something and I contacted someone way in advance, and they were kind enough to help me out and appease me. So with that, I don't want to wait too long before we start. So maybe, Emma, if we can go ahead and start, and we'll start the presentation because we got a lot to get through today and a lot of really cool material. So I am the litigation knowledge portfolio lead at Spring Law, where I help the firm with everything litigation oriented, but I also do lots of solicitor work, such as the mergers acquisition stuff in relation to employment law. And if Jeremie and Hariss want to introduce themselves, I'm more than happy to give the floor over.
Sure, my name is Jeremie Beitel. I'm the managing partner of BTL Tax Law. We're a pure tax boutique. All we do is fight the government on behalf of small business, or else help small business owners plan their tax affairs, do estate planning, set up holding companies. So we're about 15 lawyers in downtown Toronto, but we serve the country nationally. And I'm here with Hariss Safi. We'll let him introduce himself.
Morning, everyone. My name is Hariss. I am an associate at BTL, primarily help senior staff with CRA disputes, which is one of our specialties.
Awesome. Thanks, guys. I'm really looking forward to your presentation. So we can go on to the next slide. Before we really get into it, we just always want to acknowledge that the land which we operate is the traditional territory of the Anishinaabe, Haudenosaunee, Huron-Wendat, and Mississaugas of the First Credit First Nation, who have stewarded these lands for generations. We recognize that Indigenous peoples lived and thrived here long before the arrival of settlers, and we acknowledge the lasting impacts of colonialism. As part of our commitment to truth and reconciliation, we strive to learn, unlearn, and understand the history and effects of these wrongs. We are grateful to live and work on this land. Legal disclaimers. We use this funny infographic every time. Timmy doesn't need one, but we do. This is not legal advice. I'm not going to read all of this, but nothing in this presentation can be taken as legal advice. It is mere information, especially in relation to mergers and acquisitions, very complex topics. Your facts could not meet the facts of this presentation and likely do not sometimes. And just some further disclaimers. The presentation that I'm focusing on today is going to be for non-unionized workplaces. Unionized workplaces have their own implications not covered here. And this presentation also is not meant to focus on the corporate aspects of mergers and acquisitions, which are usually the largest component. We are not corporate lawyers here today. All right, so we can move on to the next one. So what are we going to talk about today? I'm going to quickly discuss, if you want to just head back for 1 second, thank you. We're going to quickly discuss share versus asset purchase in the context of employment law. I'm going to give a very brief refresher on ESA versus common law rights upon termination for employees. We'll discuss the successor employer doctrine, specifically more so in the asset purchase realm. And then I'll give some strategies for mitigating risk and exposure. Then our lovely colleagues from BTL will take over to wow us with their tax presentation. And then I'll give one slide on what kind of when worlds collide, specifically when tax and employment implications meet in the context of a merger and acquisition. And then we'll have some time for questions and answers, okay? So we'll dive right in. So share versus asset purchase. When you decide to purchase or sell a company, there are lots of employment implications beyond regular corporate implications. So choosing which one is quite important. So a share purchase, when you sell a company as a share purchase or purchase one, the legal employer just does not change, for the most part, subject to very few exceptions. So there's no change in employment relationship. The purchaser inherits contractual relationships. The purchaser should assess employment contracts, assess any previous active future leaves, any litigation against the company by active employees or previous employees, all standard parts of their due diligence. Now, conversely, in an asset purchase, it gets much more complicated, and that's why the majority of this presentation will be covering asset purchases, because in an asset purchase, upon the sale of the business, it's an instant constructive dismissal of all employees, subject to very few exceptions. So we'll discuss this later in further slides. So the refresher on ESA versus common law rights. So an employee, depending on whether they have an enforceable employment contract or not, in Ontario or Canada-wide, they have two different entitlements upon their termination of employment. If there's an enforceable employment contract with a termination clause that limits their entitlements to Employment Standards Act or Code, depending on the province, minimums, that individual is only entitled to what those minimums are in that legislation. So in Ontario, this is the termination pay of roughly 1 week per year of service, up to a maximum of 8 weeks. And if the person has been working there for 5 years or more, and the company has a global payroll of over 2.5 million, global payroll, they're owed further severance pay of an extra 1 week per year of service, prorated per how many weeks they have in that year, up to a maximum of 26 weeks. So if you have a strong employment contract, maximum of 34 weeks entitlement, subject to mass termination entitlements, which we just won't go over too much today at all. But then if there's no enforceable contract, which to be honest is the majority of the time, because the courts scrutinize termination provisions very, very closely, and the majority of termination provisions aren't up to date and written by qualified employment counsel. So upon termination in those circumstances, an employee is entitled to what's called common law notice of termination or pay in lieu thereof, which is roughly 1 to 2 months per year of service, depending on their length of service, the type of employment they had, and their age, and some other factors. Next slide, please. So what's the successor employer doctrine? Happy to chat about it. So the next slide, this is a doctrine that encompasses the idea that owners of a purchase company inherit certain liabilities that come with the employees from the sold company. In a share purchase, like I talked about, the length of service for the employees just keeps running. There's no change of employer at law. Just keeps going. There's absolutely no change. In an asset purchase, it gets more complicated. And this is what we're going to break down here. Next slide, please. So importantly, Section 9 of the ESA implies that the continuation of service for ESA rights, not common law rights, upon the sale of a business. So ESA termination pay continues to accrue for employees that go from one employer to the purchasing employer, even in an asset purchase, as long as there's no break of 13 weeks, right? This is important to know that even if you implement valid employment contracts, the 8 weeks max, even if the seller pays it out upon the asset sale of the company, the purchaser will still be required to pay out termination pay based on cumulative service. So in practice, if the seller pays out, let's say, 6 weeks upon the asset sale for a 6-year employee, and then the subsequent purchaser of the company terminates after 2 more years, they have to pay the full 8 weeks. Okay, severance pay can potentially be paid out. That additional 1 week per year of service, up to 26 weeks, can potentially be paid out before, and you get a credit on that, but we won't go into the intricacies of that today. The main concept is that ESA termination rights flow through to the next employer and accumulate as if they were employed the whole time. Okay, so often what happens is the old employer pays out ESA termination and severance pay, and the purchaser assumes that they're not on the hook for that, right? This is done without realizing that Section 9 of the ESA would still require the new employer to pay out ESA termination and potentially ESA severance pay for the whole tenure. There are strategies to avoid these mistakes. We see these mistakes all the time. And where we see them is usually a corporate lawyer calls an employment lawyer about a week before the sale is about to close and say, hey, I just wanted to double check that everything in this asset sale is tickety-boo on employment rights for all employees who are being terminated. And the employment lawyer says, I hate to stress you out, but, right? And then we tell them that the purchaser is inheriting a bunch of statutory liability for 1, 2, 3, 100 employees that they did not realize that they were inheriting, right? Which changes the dynamics of the deal drastically and can really upset the apple cart for a closing date and everything else, right? So there are lots of strategies to mitigate this kind of exposure. Most notably, there's a process by which the purchaser offers contracts and inherits the employees, and the ESA flows without the seller actually paying it out, and therefore the seller and the purchaser can create a deal on who's paying what and how much, right? That's where the open, transparent negotiations can be much more fruitful than figuring out liabilities down the line. And that's how lawsuits often start between purchasers and sellers, is that there's a bunch of inherited liability that they weren't expecting. So next slide, please. Common law entitlements. So the asset sale of a corporation, like I said, is a deemed constructive dismissal upon closing. So there's this concept of novation where if the purchaser and the seller overtly agree and the employee agrees, it's a three-part agreement, that the purchaser inherits all common law liability, then it just flows through. This almost never happens. It does happen sometimes with big corporations that are just acknowledging service and moving on, but with small companies, it's rare that a purchaser wants to inherit that common liability overtly, right? So if an employee is entitled to common law notice upon the asset constructive dismissal, then the seller may be on the hook for the common law notice for the whole tenure, right? However, if the purchaser offers comparable employment let me go back. If an employee is entitled to common law notice upon the constructive dismissal, the seller may be on the hook for that common law notice upon the constructive dismissal. Okay, this is important because if there's no enforceable employment contract, which is the most common circumstance, the seller may be on the hook for a large amount of common law notice, right? However, if an employee refuses employment with the purchaser for invalid reasons, let's say that they're offering exactly comparable employment and there's no toxic work environment, nothing has happened, and they refuse that employment, the employee will likely be deemed to have failed to mitigate their damages, so failed to accept a comparable job. So the seller would not be on the hook potentially for the entirety of the notice period or any of it because the employee is wrongly refusing comparable employment. So it's important to know the niches and the nuances of the strategies on these asset sales and who is liable for what and what the employee's rights truly are. So next slide, please. So generally, once an employee signs a contract with the purchaser, the employment relationship and related common law liabilities flow to the purchaser. Of course, this is subject to extenuating circumstances where the seller and the purchaser may be brought into a wrongful dismissal case together. Okay, the purchaser will often be on the hook for most, if not all, the tenure for common law notice calculation. Sometimes they get a break because a court will assess that the time with the seller doesn't count year for year for the time with the purchaser, but that's subject to many different facts that we just won't dive into too deep today. So if we can move on to the next. Even if the purchaser is not on the hook for all the 10 years, all the tenure from the time with the seller to the time with the purchaser, employees are usually given a big notice period bump if they come with the business that is purchased, even if somehow their length of service is interrupted. So for example, a 13-week gap between seller and purchaser happens, technically not entitled to a 10-year of service under ESA Section 9 or maybe even common law. However, a court will potentially give that employee credit for the time served with the seller if the purchaser has obtained a significant benefit from the employee's time with the seller. Okay, this is due to the knowledge and value add given to the new corporation and time served in the previous role. So if there's no valid contract, you're still looking at a common law notice bump. This is most common when the owner of a small company sells the company to a purchaser, gets hired on by the purchaser to help run the company, establish the company, and then gets terminated shortly thereafter. Happens all the time. It's called a knowledge drain and termination, right? And in those circumstances, the courts will give that employee a big bump because they deem the new purchaser employer to have a huge benefit given to them as a result of hiring this employee and terminating them shortly thereafter. It also sometimes happens, some interesting case law, on when executive assistants come with like a partner, right? Executive assistant with a partner leaves an accounting firm or even a law firm, 30 years at one firm, goes to a new firm, executive assistant gets terminated shortly thereafter, they'd probably get a big bump in the notice period as well. So next slide, please. So strategies for mitigating risk and exposure. What everyone wants to hear, I'm sure. And again, not legal advice. But so you really have to choose a share or asset purchase wisely. There are various corporate reasons and financial reasons for choosing an asset versus a share sale. Often asset share sales will be more profitable for the seller. Sometimes they're not, but there are many, many reasons, corporate or otherwise, to choose. But choose it carefully from a liability standpoint and get advice beforehand to make sure you're choosing correctly. Do a thorough review again of all employees, ages, lengths of service, roles, employee files, and compensation. Include a review of all contracts and all compensation plans and any leaves, whether asset or share purchase, right? I fought a case last year where there was a valid contract, share purchase happened, constructive dismissal happened with the purchaser. There was a valid contract with the previous company that was bought on a share sale. Arguably that contract is valid, right? So it's important to see all this stuff and assess any previous active litigation or potential litigation. Next slide, please. So termination agreements. Often a purchaser can require a seller to terminate certain high-risk employees prior to the sale and be responsible for all costs associated with such termination. Notably, and I have to say very loudly, even though it's in small writing, these have to be done carefully as they come with lots of risks. These high-risk employees often have human rights implications associated with them, various leaves, so they have to be handled carefully. Split cost agreements. If a purchaser has lots of leverage, they can make a vendor responsible for a certain portion of termination costs down the road should they terminate a high-risk employee that doesn't work out. This happens when a vendor gives assurances that some employees are great and will be an asset, but the purchaser does not really want to inherit such a long-term, high-paid employee without some assurances from the vendor. This is very purchaser-friendly and tough to negotiate unless the purchaser is really holding all the cards or most of them in the negotiation. So next slide. New employment contracts. I can't stress this enough. Whether share or asset purchase, a sale of a business is a perfect opportunity to put all employees on brand new employment contracts with beautiful termination provisions drafted by Spring Law that will be enforceable currently as per the case law to help mitigate liability, right? So the last piece is a mitigation strategy, but a pain point for a lot of employment lawyers, and I kind of talked about it before. Corporate lawyers versus employment lawyers. Corporate lawyers are great, but some of them ignore getting employment lawyer involved to avoid extra time and cost on a file that is not recoupable by the firm, specifically if it's a corporate lawyer that is a solo practitioner or a practitioner in a small firm that isn't a full service firm that doesn't have an employment department, right? So it happens all the time. And also vendors and purchasers themselves will avoid getting employment lawyers involved because of the extra costs. However, the cost save upfront is the story as old as time, right? That an ounce of prevention is worth a pound of cure, because saving the money up front almost always leads to way more money being owed to a high value employee down the line because T's weren't crossed and I's weren't dotted on the time of sale. So next slide, please. All right, so I'm going to turn it over to our friends at Beitel Tax Law Group, and I'm really looking forward to this part. So the floor is theirs.
Thank you, Philip. I will now share my screen. So let me just get this in order. Okay.
It's really fun seeing presentations from other areas of law. It's been a long time since I've really heard everything about the employment side of M&A. And certainly with some of our deals, you got me thinking, maybe I should call Philip today.
Okay, can you all see only my slides and not my notes?
Yes.
We can.
Now, yes.
Perfect, so that looks good.
Fire away.
Thank you. Okay, hello everyone. My name is Hariss, and on behalf of Beitel Tax Law LLP, I'd like to thank you all for attending this webinar today on the tax implications of mergers and acquisitions. Once again, thank you to Philip, Emma, and Spring Law for having us here as presenters. We're honored to be here. So to start, a little bit about us at BTL. Jeremie already gave a bit of an introduction, but again, we are a tax law firm for the owner-manager. We look to help business owners and professionals such as yourselves. One of our specialties is in tax structuring and creating tax efficient strategies to preserve wealth for owner-managers. We also act as trusted advisors, guiding family businesses and private companies through inception, growth, succession planning, and the implementation of tax-effective sales strategies, which will be our topic for today. Alongside me here today is Mr. Beitel himself, Jeremie. Jeremie, if you want to give another introduction and show off that excellent beard once again.
Yeah, that's the only part that I want to add from what is said before. So I'll let you keep going. And yeah, it's all right there. We do full service tax law, and happy to help with anything you need.
Thanks, Jeremie. And once again, I'm Hariss, associate at Beitel Tax Law, experience in some tax planning myself, mainly in the international tax planning context, as well as for the lifetime capital gains exemption, which will be one of our topics for today. Primarily at Beitel, I support senior staff with CRA disputes, CRA disputes being one of our other specialties at BTL. So again, our topic for today is the tax implications of mergers and acquisitions, and these are the three main topics that we're going to be discussing. First, when it comes to selling your business, how you want to sell your business, share sale versus asset sale, which is something that Philip touched upon earlier as well. Second, the lifetime capital gains exemption, what it is, what is its benefits, how do you access it? And third, the use of reverse earnouts. I will be presenting on the first two topics, and Jeremie will be presenting on the last topic. And Jeremie will also be coming in at points to elaborate on the things that I talk about and to answer your questions as well. So to begin, share sales versus asset sales, considering how you want to sell your business. So in general, sellers will prefer share sales from a tax perspective. First, because they get access to this this tax concept known as the lifetime capital gains exemption, or potential access. In essence, the lifetime capital gains exemption allows you to potentially get a huge deduction or even potentially eliminate all the taxes that arise on the gains from the sale of your shares. We'll dig a little deeper into the lifetime capital gains exemption for the next topic, but the main thing to know is that it's a potentially very helpful tax benefit when considering the share sale of your business. The other benefit of a share sale is tax deferral. So this generally involves some planning through the use of what are known as rollovers and reserves. But the benefit is, of course, you have more access to cash on hand, and you can use that towards your other endeavors or for your investments. Oh, sorry. Now, sellers, generally, there are exceptions, of course, generally do not prefer share sales because they lose access to this tax concept known as the step up. To keep things as simple as possible, I'm sure many of you have heard of this idea of the capital cost allowance, or maybe none of you have, but it allows you to access deductions for the depreciation of your assets. In a share sale, a buyer gets less of that, so they get less deductions going forward. and it's just the worst outcome for them, generally speaking. And there's some non-tax considerations to think about for a share sale as well. And by non-tax, I mean just business considerations or practical considerations, some of which Philip touched upon earlier. But for the most part, share sales are generally more simple for both the seller and the buyer. With regards to the seller, less third-party consents are required because the underlying entity remains the same. You don't have to worry about assigning contracts and getting permission, for example, from the bank or from your landlord to assign a contract to a different party. One of the downsides to a share sale for the seller is that there is some added complexity if the seller wants to keep some of its assets. Just some more paperwork and negotiation involved generally. One of the benefits in a share sale, like Philip touched upon earlier, is that you get to retain the employees. They come along with the corporation that you're buying. One of the downsides is that one of the things that also comes with the corporation is any pre-existing liabilities. So those were considerations for share sales. Now we're going to move on to asset sales. Generally, asset sales are preferred by the buyer because they get access to that concept of the step up that we talked about earlier. So it gives them access to more deductions going forward. So they, less taxable income, less tax. Another benefit is this idea of the purchase price allocation, which again lets them determine how much of a price to allocate to each asset, which can maximize their tax deductions going forward. In general, sellers do not prefer asset sales from a tax perspective because they lose access to that lifetime capital gains exemption. And once again, talking about CCA, there's this potential for recapture on depreciable property. So essentially what it means is that seller may have to pay back some of the tax benefits that they had previously received. Some non-tax considerations to keep in mind for an asset sale. Generally, it's more flexible for both the buyer and the seller. You get to pick and choose what assets you want to buy and sell. Also, for both the buyer and seller, it's generally more complicated. Just involves a lot of registrations, consents, notices, a lot of different issues that can come up. One of the downsides for the seller in an asset sale is that you're selling your assets, but any pre-existing liabilities stay with the corporation. So you still have to continue to deal with those. One of the downsides for a buyer in an asset sale is the hiring or rehiring of employees, like Philip touched upon earlier. So those are some considerations for share sales versus asset sales. I will now pass it on to Jeremie to provide his thoughts and expertise.
Yeah, I'll keep it fairly short. I know, and this probably biased partly by the fact that we're a tax firm, but I rarely see asset sales. Obviously, I see companies sell assets, but where you're buying the entirety of the business, even where we have to do some complex tax planning in advance, it's just tough to beat the capital gains exemption for small private companies. Obviously, when you get 10 million, 25 million, the capital gains exemption becomes less central. But if you're selling a $4 million company, getting 1.2 tax free, and Hariss is going to touch on this shortly, potentially many multiples of that if you have a family trust, it's just tough to beat that for the buyer or the seller. So even though the seller is the one that benefits from the sale, as a negotiating point, if you can cut the government out of $500,000, $1 million, there's a way to allocate that added benefit that's just better for both parties. Capital cost allowance is great, but deduction on goodwill of a handful of % a year over 20 years, neither side is as excited about that as they might be. Yeah, that's all I'll say there. There's lots of other things we could talk about in tax and share sale versus asset sale. So if anyone has any questions or things they want us to touch on, feel free to put it into the questions. Go ahead, Hariss.
Yeah, thanks, Jeremie. Yeah, there is a lot to talk about, especially with regards to tax. But yeah, again, feel free to ask us any questions now or even afterwards. Feel free to reach out. For our next topic, we're going to be diving a little bit more in depth into the lifetime capital gains exemption. So the lifetime capital gains exemption, which I've abbreviated as the LCGE, allows you to reduce the taxes that arise on capital gains from the sale of your business. The LCGE is currently at $1,275,000. So this means that you can deduct the gains up to that amount. It's indexed for inflation, so year over year, it'll It'll increase alongside inflation. It's important to note that this is like a cumulative lifetime limit, meaning it applies to total gains over your lifetime. There is no reset. It's not like at the end of a year or 10 years you're going to get it back. It is cumulative for your lifetime. The LCGE is very technical, so we highly recommend advanced planning to ensure that you're eligible and to also maximize your benefits. So there are 4 primary requirements that we're going to be touching upon with regards to the LCGE. Starting with a share sale. So the LCGE is only available for share sales, like we talked about earlier. Access to the LCGE is a very important thing to keep in mind when considering how you want to sell your business. If you are eligible for the LCGE, like Jeremie touched upon, it's very likely that you'll want to pursue a share sale and try to sell your business in that way. And then to emphasize another point as well, the LCGE is for the seller. So you're the seller, you're the one selling your shares. You realize a gain on that sale, and you use the LCGE against your gain. So again, it's for the seller in a share sale. So in order to be eligible for the LCGE, the seller must be an individual or certain types of trusts. The shares cannot be sold by a corporation. So this could lead to issues if, for example, the shares of your business are held by your holding company. Then generally some additional steps will need to be taken to ensure that you can properly access the LCGE. Another important requirement for the LCGE is that you have to be a resident of Canada. So it's only available for Canadian residents. You will generally be considered to be resident in Canada so long as you have a home, a spouse, or a dependent in Canada. So if you have any one of those in Canada, generally you're considered a Canadian resident. Alternatively, if you're physically in Canada, like your body is in Canada for at least 183 days, you're deemed to be in Canada. So any of those 2 or technically 4 requirements, if you satisfy those, you'll be considered a Canadian resident. Oof, and now for the most technical aspect of the LCGE, and I ask you all to bear with me, please. It might get a little technical at times, but I'll try to keep it as simple as possible. In order to access the LCGE, the corporation that you're selling, your business, has to be a small business corporation. Essentially, the corporation cannot be a publicly traded corporation. It cannot be a crown corporation. It cannot be controlled by any of those 2. And it must have been incorporated in Canada. So through, for example, the statutes of Ontario or through the federal statutes. So alongside what I just mentioned, we have this asset value test. So at least 90% of the fair market value of your business's assets must be used in an active business in Canada. So an example to help illustrate this point, let's say you have your corporation has $1 million worth of assets, $900,000 of which is machinery for creating widgets in Canada. Well, 90% of the value is used in an active business in Canada, so you would satisfy that test. If instead the machinery was worth 800K and the remaining 200K was something else, then you would not satisfy this test. And this test is at the point of sale, at the time of sale. So alongside all of that, so the details, the characteristics of the corporation and the asset value test, we have these 24-month tests. So for the entirety of the 24 months before the sale, the shares of the corporation cannot have been owned by an unrelated owner. So in essence, what this means is that it has to have been owned by you, your spouse, your child, or your parents, with some other exceptions in there as well. Also, for the entire 24 months before, at least 50% of the assets of your business must have been used in an active business in Canada. So going back to that machinery example, if let's say there was a time 12 months ago where your machinery was only worth 40% of the total assets of your business, then unfortunately, you would likely not meet this test. So digging a little deeper into this active business requirement, the definition of active business means any business other than business from passive income. So generally, where passive income will refer to like rent. So active business for the purposes of this presentation will mean business other than like rental income or like dividends or interest and things like that. This concept becomes really important if your corporation owns real estate. Real estate can take up a huge chunk of the value of your business, so you want to ensure that it's used towards an active business so that you can access the LCGE. Real estate leased to an associated corporation can be active business. So like I said earlier, generally rental income is not considered active business, but in this situation where it's leased to an associated corporation, that would be fine. Also, the real estate, as long as it's primarily used towards an active business, that's okay. It satisfies the test. Good. If it has like the secondary goal of earning some rental income and it's not the main thing that the real estate is used for, that should generally be fine, and the real estate is still good for LCGE purposes. Other things to keep in mind is that goodwill is considered an asset, and it often helps meet the test. It's used towards the active business. Two things generally make it difficult to meet the asset use test, and that is cash and passive investments. And generally, if your corporation holds a lot of cash or passive investments, then you'll probably need a purification strategy. By purifying, what we mean is that your corporation gets rid of the bad assets. I mean, cash and passive investments are not bad assets for the most part, but for LCGE purposes, you want to purify, right? You don't want them to be in there. The issue is that one way to do this is, through a dividend to your holding company, and you pass off your cash or investments that way. But this leads to issues because, like we said earlier, the LCGE is only available for individuals and not corporations. So the gold standard is to use a family trust. There's other ways as well, but the family trust is the gold standard. But we highly recommend seeking professional advice to maximize the benefits of a family trust, and it's in general just pretty technical.
If I can jump in there, Hariss.
Yeah.
Oh, sorry. I just want to go back to, when we can we go to the previous, yeah, so if you think about this practically, and I think we're talking about this presentation from the perspective of a seller, because that's where the planning comes in typically. When you decide to sell, you can't then achieve a 24-month test, right? And you don't want to kind of get a surprise offer or have a reason to sell and then say, okay, we can do this deal. Just give me 2 years of purifying the company. So once you have a business that's worth tax planning for, if you have a dog walking business, you're making 100K a year, you're living off of it, great. You don't need a holding company for that. But typically where you start to need tax planning, if it's a saleable business, is once you've started to break or potentially break that 50% test. And to Harris's point, it's the thing that breaks it is the good thing, right? You have retained earnings, you have cash, you have portfolio investments, and you're leaving them in the corporation because you want that tax deferral. You don't want to pay the shareholder level tax on a dividend. So you're in that good situation. You're building up cash in your company. This is where you hit into this paradox. So the simplest thing is you transfer all of your shares of your operating company into a holding company. Now dividends can be paid up. You can remove the cash from your operating company. Simplest possible structure. But because an individual has to sell the shares to get the capital gains exemption, the individual now owns the shares of the holdco, which in turn owns the opco. So you still have that passive bad asset in the corporation owned by the individual. So what you end up needing to do is sort of suck and blow. You need to do two opposite things. The holding company needs to own the shares so it can receive dividends tax-free. So intercompany dividends aren't taxed in Canada. So that's how you get the deferral while still achieving creditor protection and getting the cash out of your operating company. But at the same time, you as an individual need to own the shares so that you can get the capital gains exemption on a sale. And obviously both can't own the shares at the same time. So when we say the gold standard is the family trust, what we mean is that a family trust acts kind of like a switch on a railroad. So whenever a dividend is paid, so the family trust would own the shares of the operating company. Whenever a family trust receives a dividend or receives sale proceeds, it gets to decide where to allocate that. So it could say for dividends, it allocates them to the holdco where they're tax-free. For sale proceeds, it allocates them to the individual beneficiaries so that they're tax-free using the capital gains exemption. So that's why we say it's the gold standard. It's the best solution. That said, it's also the most expensive solution. It's the most complicated. If you have a $500,000 business that's making a couple, $300K a year, you may wonder, do I need a family trust? Is it worth spending that money, adding that compliance burden? And that's where we get into other solutions, whether it's multiple share classes, whether it's using what's called a butterfly, and is named a butterfly because if you diagram it all out, the various lines and squares for the corporations look like a butterfly. Tax lawyers being very poetic. And that's universally what it's called in Canada. But they're all different ways to get around this paradox. So that the individual, if you don't have a family trust, what you need to end up with is a way to pay dividends to the holdco while still having shares with value owned by the individual shareholders. But the important point is you need to have done this and keep doing it 24 months before you want to sell. So the best practice is usually to do this on an ongoing basis for any saleable business or any business that has value. Because the one sale you can't plan for, obviously, is debt. Right? When a person dies, they're deemed to have sold their business at fair market value. So typically the advice is if you have a business of any value, you purify it on an ongoing basis. You make sure that the cash and passive assets go off to a holdco so that the operating company is pure. It doesn't have any non-business assets. And obviously there's creditor protection benefits to this as well. So with that said, I'll pass it back to Hariss. I just wanted to jump in and provide some of the gloss there.
Thanks, Jeremie. Final point on the LCGE, just some more strategic considerations. So like we said earlier, the LCGE is $1,275,000. So this is the amount that's deducted from your capital gain. But this can be multiplied through a strategy known as an estate freeze. So in the example here, if you have a family of 4, you can shelter up to $5,125,000 worth of gains, which can save you a lot of tax long term. But the thing with an estate freeze, and to Jeremie's point, is that only appreciation and value after the estate freeze can be multiplied through a trust. So we strongly recommend proactive planning and also strongly recommend that you seek professional tax advice. And if I had to say, I'd strongly recommend our professional tax advice. And with that, I will pass it along to Jeremie.
Awesome. So yeah, when we, I'll touch on an estate freeze briefly. So estate freeze is just how you get it into a trust. You can't actually transfer wealth into a family trust. So what you do is you get your business valued, or you do a napkin valuation, and you say, okay, my business is worth $4 million, and I own all the shares. I'm going to exchange my shares for a special class of shares that has one fixed value. So it'll only, sunshine, being bought out by Google, whatever happens, my shares are only worth $4 million. And it's accepted as a principle, even though it's in some sense it's not technically true. It's accepted as a principle that after you do that, if your shares are worth whatever the business is worth, the family trust can pay $100 for new common shares, and that'll be considered at fair market value, because the idea is that the new shares are worth $0, because the business is worth $4 million and your shares are worth $4 million. Obviously, that's not literally true. I mean, if someone was willing to offer me, common shares in a successful business for $100 and get all the growth, obviously I'd pay more than $100,000. They're more than $100. But the CRA accepts this. It's a staple of Canadian tax law that you can do that. So that's an estate freeze, and you typically do that, and then you can either buy back those shares over time, or your company becomes worth more, and now the trust is enriched. So if ever you sell, the buyer buys those freeze shares from you and the common shares from the trust. And since the trust paid $100 and now those shares are hopefully worth millions, it realizes a big gain and allocates it out to all the members of your family. So you use up all of your family members' capital gains exemption. Downside is Junior doesn't get one of his own later or her own later. The upside is they get $1 million. I wish my family had used up my exemption and given me $1 million, but wasn't to be. The one challenge there is you do have to literally give the money to your kid. You don't have to give them a bank account with $1 million, but you can't sort of use their capital gains exemption, but keep it all for yourself. So you really do have to give them the money, but typically you use holding companies or a trust to maintain an adequate level of control until they grow into their newfound wealth. So I think I've touched on most of the points here in advance. The only other piece that I'll add is that the best time for tax planning is that 24-month before. But even if you're coming, if you haven't proactively done that, Oftentimes, private companies will still qualify unless they have egregiously high retained earnings, just because of the goodwill factor. And in the context of a sale, it's much easier to value goodwill because you know the value of goodwill is whatever's not on the balance sheet. If you're selling your company for 4 million and your book value is 2 million, you can attribute 2 million of goodwill. And that's already going to get you, in that example, to the 50% test. So making sure that you have an accountant who's live to these issues as early as possible in the sale process. And you really want to have it reviewed at the letter of intent stage, because, and we'll get to this also as I get to the earnout, the letter of intent will usually specify who the vendor is, what the form of the transaction will be, et cetera. And if you add in later that, oh, I'm going to sell you the holding company, that can sort of spook purchasers, especially if they're not sophisticated. Whereas if right from the beginning you say, look, I'm going to want to sell you my holding company, and here's what we're going to do to meet the test, or whatever the case may be, you want to be thinking about these things right from the start. Okay, should we move on to the earnouts? I think is our next piece. So reverse earnouts. So this is a common feature in private company sales. You say, the purchase price will be $1 million plus 30% of net profits over the next 5 years. It's a weird artifact of Canadian tax law. There's a provision that says that any payment based on the income from property, or based on the performance of a business in future, is taxable as income. So for the vendor, the risk is and I see this all the time, I would say the majority of time when I see a letter of intent, it includes an earnout rather than a reverse earnout, especially if it's US counsel, because this is just a strange artifact of Canadian tax law. Or if the buyer is from the US, I should say, like US private equity. So a standard earnout says you get more money as the vendor if XYZ happens, or based on profitability. So that would be treated as income to them. So rather than getting a capital gain, or even better, tax-free because of the capital gains exemption, now you just have business income. So the solution, if I can go to the next slide, is what's called a reverse earnout agreement. They're economically identical. There's no difference. It's just algebra. Like 2 plus 2 equals 4. Well, 4 minus 2 equals 2. It's the exact same thing. What you do is, in that example, so let's say it was 2 million plus 30% of the profits over the next 5 years. Instead, you would say it's 2 million plus a $2 million payment for goodwill, and you conclude a provision that says that $2 million payment is reduced if we don't hit a given performance target. So obviously, I won't attempt to do the algebra on screen here because I'm going to mess it up, but you can get to the same result, to where, because 30% of the profits gets you to a certain dollar figure at a certain profit figure, you can match that by sort of starting high and going down. But if you use a reverse earnout, then and you follow I won't go through everything in the IT bulletin. There's a few different, like the cost recovery method. There's a lot of technicality here, but if you do it right, you get to have capital gains treatment, even though it's economically identical. There's no disadvantage to the purchaser. So there's really no reason to ever see, in my view, an earnout in a Canadian private company sale. You should always see a reverse earnout. It's just a matter of proper drafting and proper tax analysis. But again, you want to have that at the letter of intent stage, because you don't want to be after an agreement. Specifically, once you sign letter of intent, the purchaser is going to draft their big agreement. You don't want to, at that point, be negotiating, trying to swap it into a reverse earnout. So it's one of these things that can be very easily done at the start, harder to do later. Can I go to the next slide? If I have another slide on this. No, I don't. Thank you. Yeah, I couldn't remember if I included a slide on the cost recovery method, but I didn't.
Thanks, Jeremy. And I will pass it back to Philip.
Thank you so much, guys. It's been said here in our chat, we could watch this 10 times probably and still absorb more for you. So tax stuff is always super rich in knowledge, and and we really appreciate you coming on. So thank you. That was exceptionally informative. Thanks, guys. And I put one slide on when worlds collide because I knew that we might be a little low on time at the end of this presentation. So if there are any questions, we do want to get to them. There's one area of employment law and tax law that really do collide when businesses do business in Canada, either from outside of the country or interprovincially, right? And this is really when the employment and tax implications do collide sometimes. So we can go to the next slide. And I kind of just condensed it into one because we could have a whole presentation just on this, is especially with remote workers, right? So remote work has different employment and tax considerations, whether the employee is within Canada or abroad. From our perspective, you always want to start with the employee versus independent contractor analysis. Full transparent note, true independent contractors in Canada are very rare, right? And without going into the tax implications, there will be implications if someone's working remotely from BC for a Ontario company, right? Or working remotely in Ontario for a US company, but that's more on the US side, right? So there are various implications, both employment and tax. And within employment, there are different implications for employment standards minimums, which will usually be within the province, and then WSIB sometimes is in the province where the business is located, not the person, right? But employment standards are where the person is, right? So there are intricate differences in various statutory rights and common law rights depending on where a worker is physically located and where the business is physically located, and especially so where money starts crossing provincial or international national borders, right? So that's just an important note that I wanted to put forward here today. And with that, I'm all done, and I want to thank Hariss and Jeremie again. And we more definitely want to answer questions that have come in if there are any. Emma, do we have questions that have been popping up, or do we have any that are coming in just now?
Not at the moment, but feel free to send any questions.
Okay, yeah, feel free to send them in. This is rare. Usually we have tons of questions. Maybe we bored everyone to death, and that's okay. That happens.
Or we just answered every possible thing we were so comprehensive that they were just like, well, I know everything now. Yeah. To touch on your last point, it's interesting, like what crosses borders. What I've seen a lot of throughout my career is people not realizing the impact of humans moving across borders, and especially foreign companies doing business in Canada and having their people cross in, and then the host of tax obligations that can be created, and especially reporting obligations for employers. Sometimes there's no tax, but just the fact that you didn't report, you end up with these 10% penalties that are quite significant. So yeah, to Philip's point, it's one of these things that you cannot notice and then have a massive problem. Whereas just like a quick advice at the start, you can either be told there's no issue or get ahead of it and avoid those penalties later.
Absolutely. And like, us lawyers, we preach the ounce of prevention a lot, and it's hard for especially small business owners to invest a lot of money on the sale. But I have a small commercial litigation practice too, and the amount of times I see business disputes come up because everything just wasn't addressed before a business was sold, whether it's tax implications or simply earnouts and the amount of money at stake and liabilities that flow with it causes a dispute, and all of a sudden someone that was selling their business and riding off to the sunset and living on a beach is now just embroiled in litigation for 15 years while trying to live on a beach somewhere else, right? So it happens more often than we think, and proper planning can really avoid that. And definitely the last person you want is CRA joining the battle, right? Because they'll put you in jail. So maybe. But if there are no other questions, I'm happy to give the floor if there's anything else, Jeremie or Hariss, that you have, because I am all done for the day.
Yeah, I don't know. I mean, I'm always hesitant to, well, we have 5 minutes left. I don't know if you're hoping to do the next, talk about the next one. I will say quickly,
sure.
We didn't include slides on this, but the other major thing to think about in M&A is losses. Tax losses are incredibly valuable. So if you have a company that fails, just being aware that you do have that ability to, have a similar business, use those losses against future profits or another one of your own businesses. So just being aware early of the tax attributes you have and how those could impact a potential sale.
Yeah, absolutely. And I think it's a very fair point. We can always talk about the next presentation too. It is a doozy. We do this every year, or in some iterations, sometimes more than once a year. The next episode, 68, is medical leave, long-term disability, and return to work, navigating the gray zones. One of our most attended webinars, one of the most practiced area in our firm and any employment firm is managing these types of tricky leaves and medical issues with employees. Please do attend should you have the time and sign up for episode 68. It'll be another great presentation. So and this is our lovely team, and I just want to thank the co-presenters again, Hariss and Jeremie, for coming along today, and thank you, Emma, for all your hard work in the background. It's been a pleasure, and I hope everyone has a lovely day, and you know where to find us.
Thanks, Philip.
All right, take care, everyone. Bye.